on the inflation side, we see a year ago the commodity prices started falling pretty precipitously, and so now we're coming up against the comparison against that drop. So commodity prices, which had been down on a year-over-year basis by 20 to 30%, are now down roughly 12%. So again, we're comparing against declines last year. Now, if you look at the Bloomberg Commodity Price Index, it is still in a downtrend. So that is a leading indicator for inflation. The PPI reported this past month was up 1.1% on a year-over-year basis. So the Fed has a 2% target on a year-over-year basis. We've got two leading indicators that are well below that, commodity prices and the PPI up only 1.1. If you look at the retail sales deflator, this is a number you kind of have to back into, and not many people pay attention to it. But it does belong to the retail sales report, which is a little more goods-oriented than services-oriented, but that is up only 0.2% on a year-over-year basis, and that is a consumer inflation measure. We do have the CPI. The last print was 0.1% month to month, so very good, well-behaved month to month, but still up 4% on a year-over-year basis. Now, this next month, so for June, and this report I think will be out next week, the comparison against a year ago was month to month, the CPI from May to June a year ago went up 1.2%. So if we see the CPI up only 0.2% this month, month to month, then we will be dropping off a full percentage point, and that will take the year-over-year down from 4% to 3%. I know that's maybe a lot to digest right now, but it's the comparison against a very big increase last year that gets us down from 4% on a year-over-year basis, which was reported for May for the CPI, down to 3% in 1 month. And if perchance it's lower than 0.2, then we will be dropping in to the 2% territory, maybe 2.8 or 2.9%.
Hello, and welcome to Money Talks. In today's video, Cathie Wood talks about the latest updates on inflation, the next move of the Fed, and the reason for raising bankruptcies. She also gives us her prediction for the next 5 years of Bitcoin and artificial intelligence. So without further ado, let's get started with the video.
Now, just to the backdrop, though, away from these numbers, we're seeing rising bankruptcies. And a lot of the reason for this is because a lot of businesses take loans out on a floating rate basis. In fact, those are the only kinds of loans they can get. And the rates have gone up so much, 21-fold if you look at the Fed funds rate in a little more than a year. And a lot of businesses just cannot afford these loans anymore. And you're seeing the same with commercial real estate. Strategic defaults left, right, and center just can't put up with the interest rate increases and the empty office buildings. One of my dear friends, a doctor in one of the best parts of New York City, Madison Avenue, Midtown, she's being evicted, and so is everyone else in the building because it's only half full. And this used to be prime property. Maybe that's too New York specific, but I wouldn't be surprised to see the same thing happening in many other big cities around the world, maybe even the smaller ones, given the regional bank issues out there. Where else would we expect to see issues having to do with this massive increase in interest rates in such a short period of time? Well, we're learning now that in the private equity world, where you see a lot of collateralized loans, that there were $3 trillion. This is as of last August, but by that time, the Fed had already been jacking interest rates up by 75 basis points at a clip. $3 trillion in adjustable rate, unhedged loans of that sort. So I think underneath the surface out there, we're not hearing a lot about this, but that there is a lot of pain, and we also see that that the KRE, which is the regional bank index, is just wallowing around where it was roughly during the regional bank crisis earlier this year. So no real recovery there either. And of course, one of the reasons is the biggest lenders to commercial real estate these days are not the big banks. They're not allowed to allocate that much risk to commercial real estate, but the regional banks. So we believe they are in quite a bit of under some stress. And that will continue if rates continue to move up, because the incentive to move to money market funds or government-backed funds is only going to increase.
A possible approval of a spot Bitcoin exchange-traded fund, ETF, won't be a game changer for crypto markets, although it might benefit the leading cryptocurrency, according to a report by JP Morgan Managing Director Nikolaos Panagyrtsoglou. Based in London, Panagyrtsoglou is part of JP Morgan's global market strategy team. He believes that a Bitcoin ETF in the United States would have a similar impact as those seen in Canada and Europe, where spot Bitcoin ETFs have been around for some time. According to the report seen by Bloomberg, Bitcoin ETFs have overall attracted little investor interest in other jurisdictions in the past 2 years, further failing to benefit from investor outflows from gold ETFs. The strategist also sees the benefits of a Bitcoin fund receiving the green light in America. According to Panagyrtsoglou, an approval could bring more liquidity to Bitcoin markets, but could also lead to a migration of trading activity from BTC futures products. Panagyrtsoglou's view goes in a different direction from the high expectations that surround an approval of a Bitcoin ETF in the United States. During an interview on July 6th, BlackRock's CEO, Larry Fink, suggested that investors could turn to Bitcoin as a hedge against inflation and the devaluation of fiat currencies. Let's be clear, Bitcoin is an international asset, said Fink, adding, it's not based on any one currency, and so it can represent an asset that people can play as an alternative. As reported by the Labor Department, the annual inflation rate for the U.S. was 4.0% for the 12 months ending in May.
We think most investors are very short innovation. They may think they have it covered with the Magnificent Seven, as they're being called now. But we do not think they do. In fact, we think there's going to be some disruption to the Magnificent Seven, and we can get into that in another time. And we've mentioned ChatGPT as a real risk to search and Google's entire model. And there are other risks in what used to be called FANGs, or now the Magnificent Seven, some of which is even competition for the AI chip world. We think that autos have been a great case in point here. The shift towards electric is happening so much more quickly than I think the auto industry first expected and auto analysts expected, that many investors are on guard now, thinking, okay, innovation, I'm going to take it more seriously. We think that AI is going to turbocharge the speed at which these shifts take place. And so let's just talk about AI a bit. We think there's going to be a lot of commoditization coming out of AI. As you listened to Frank Downing and Will Summerlin on our last In the Know, foundation models could be commoditized. And commoditization is great for companies who harness the AI that is being commoditized to increase their productivity, increase their efficiency, and lower their unit labor costs. So that's great. That could be a boon to the entire economy. But the companies who will really benefit disproportionately are going to be those with visionary leaders, broad-based distribution, and after those two, most importantly, proprietary data that no one else has. And so that's what we spend our time focused on as we are thinking about AI. We think this move into the megatechs around AI has been more knee-jerk, and it will sort itself out as more and more people do the research. So with that, I'll close by saying, innovation solves problems. We've said that since the beginning of COVID. That's when I started doing these In the Know videos. And I believe with the margin pressures that corporations are going to face, they're going to have even more problems moving forward. So innovation, AI, they're certainly going to make use of it. Innovation, as we saw with Bitcoin around regional bank crisis, is a flight to safety. And one of the flights to safety that investors must consider is the traditional world order being disrupted magnificently by the 5 major innovation platforms around which we have centered our research: multi-omic sequencing, robotics, energy storage, artificial intelligence, and blockchain technology. And the convergence between and among those technologies is going to cause super exponential growth for some, but creative destruction for others. And so we believe in the next 5 to 10 years that investors who are short true innovation, truly disruptive innovation, are going to start moving more and more into that space, allocating capital to its highest and best use.
So what's your price prediction for Bitcoin at the end of 2023? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.